Massive party time in the stock market. It is my stock market update. So let's get going. Now, valuations, normally when they're red, it means they're overvalued. In actual fact, and green means undervalued. So you should be looking at, say, energy, banks, and so on. In actual fact, sometimes the fact that they're overvalued on traditional metrics like share price to forward earnings can suggest that, perversely, that they are perceived as stay clear, they can't possibly meet those high expectations. And when, of course, they do exceed those expectations, so you need the kind of companies which will, like an Amazon or Microsoft, which can produce superhuman earnings, they, of course, go even higher. So in a perverse way, being overvalued can have negative impact on expectations, and therefore those expectations are easier to beat, and when expectations are beaten, the price rises. Sounds weird? Well, welcome to the world of hedge fund investing. So they have been doing rather well, and we'll come back to those. Now, for those of you on my approved filtered list and Great Investments program, you'll know exactly what this is, because you've been having a pension index beating phenomenal year this year. And the reason we've been, and way we do it, is we look at value growth of the stocks, so the valuations, share price to profitability, growth such as revenue and earnings growth, dividend yields, that's all marked in a score here across 10,000 stocks. In this presentation, I will also look at cash return on capital invested, because companies in the top quartile generate 30% per annum on average. Not every year, not every company, but on average, 30% per annum if you're in the top quartile by Croakey. And momentum-based stocks, there is, from Citigroup research to show it has an impact on, but not guaranteed to a future price upward movements. And of course, we want a high Sortino and high alpha. That just comes from my hedge fund roots, because that's what it's all about. High return on volatility and beating the market, obviously, is what you want. So you pick the stocks which replicate that, which is sort of a cheating shortcut way of beating the market. You just pick the stocks which beat the market. So anyway, that's what I'm going to do and cover some of those stocks in this presentation. So how's performance been? Well, you can see it's all of those which were red in valuation, which have actually done well, and those which were green, i.e. undervalued, have done poorly. So explaining partly of what my thesis is. So exchange traded funds, I will do a future presentation on this, but as you can see in the past month, right across the board, incredibly well, except the inverse ones, which go up when the market falls or down when the market rises. Of course, the market's been rising, so don't do those. Those are high risk. Some of these are leveraged, so be careful. Don't do those. You haven't got the appetite for it. But right across the board, you can see that even the funds have been generating significant returns. I say even funds because they're a basket of stocks, good, bad, and ugly. 46% so far for the NASDAQ. It's nearly up 50% in market capitalization in 1 year. So those are my Great Investments program, and I've had more business people sign up this week. I've had more professionals sign up. People who are fed up with their IFAs, their independent financial advisors, and wondering why they've got a 0% return over 2 years from their IFA and their pension's gone nowhere over 2 years, when the NASDAQ's up 46% and the S&P 500 is up nearly 20%. Why has that happened? They're asking. And my job is, through giving them access to the approved filtered list and the Great Investments program, is to get them to be able to do it themselves and see, oh, actually, these are the good companies. They tick the value box, growth box, income box, and so on. And that's what we're seeing. And those people who were more NASDAQ heavy this year in January from my approved filtered list, they've got pretty much 100% return on their pension. Now, that will stand them well if next year they get a 0% return, let's say, for whatever reason. Let's say the market crashes next year and they just go to cash and they get no return next year. 100% this year makes up for any bad years. Similarly with the S&P 500, I've got ones which were more moderate. The pensions, people in their 70s, my clients, they would have got a 40% return on there, pretty much double that this year. But that's if they joined in January. Of course, if they're joining later, well, we'll see what happens in the next 12 months. I can't guarantee what will happen in the future at all. I cannot guarantee this will ever happen again. Of course, I can't guarantee that, but I'm optimistic. So we will do a future presentation on these as well, S&P 500 stocks, the top 10. And none of those are on my approved filtered list, but it just shows that you can have strong momentum, not be on the list. And they're not attractive enough, so there could be all sorts of other reasons why they've done it. But I will come back to that. I mean, look, Rolls-Royce I get asked a lot about, usually by the mistaken UK pensioners or savers or traders who think that because they're British, they have to be racist in their stock picks and only pick British companies. Actually, in your SIP and ISA, you can be global and pick companies from anywhere. And if you've got more choice, you'll be able to select more quality because you'll be able to filter from a larger gene pool. It's just basic statistics. S&P 500, looking wonderfully good. Now remember with this, I'm going to give you a quick lesson. I don't use these technical indicators the way the textbooks do. That is positive, that is neutral, that is negative. So this is positive. Okay, it's broken out of a downward channel. This is a channel which is downwards. It's broken out, i.e. broken above that resistance. It tends to pull back before moving up. Why and how do I say that? See those 18 books published by the FT and others? Yeah, I've done the research on it. Right. Similarly, you saw it happen here before it goes up. So we're not worried at all in this. We might get a bit of a fall, just in case you want to know what these are. That's the stochastics, which is the weekly is more sensitive, but less important. The monthly is less sensitive and a bit more important. And the most important is the monthly MACD, but least time sensitive. So you see there's a trade-off there. Anyway, I don't use these the way the textbooks do, but I'm just explaining what I see happening. So I'm relatively positive. This, not happy. It will possibly do that, but I'm just not interested. So the Apple strategy for me is this. Do we buy, hold, or sell? Well, we're certainly not selling. I continue holding what I've got, and I'm more than happy to buy more if you put a gun to my head. Why? Well, because this is, first of all, it's either rising or neutral, depending on your eyesight. It's certainly not falling. The second thing is, if the MACD is above its signal line, its yellow signal line, which it isn't here, then it's positive. Where it's there and that happens, then that gets negative, doesn't it? Where it's above, it's quite positive. Look at that. And then look what happened here, right? So that's the Apple strategy, which should be gun to my head, I'd buy more, but I'm certainly holding what I've got, certainly not selling. Apple strategy also applies to Alphabet for the same reasons. Positive, neutral, negative. Not bad. This isn't bad, even though that's a bit confused. You can see what the banks think there and seasonality on the graphs there. And the analysts think there's a return potential of 11% if it goes from current price to the average of their predictions. Okay, so I'm going to give that a woohoo as well. Microsoft is definitely going to get a woohoo because that is positive and I would buy more. There's only so much money I've got. In fact, basically, all the IFAs should give me all their client monies and, you know, to give them a better bloody performance. But actually my philosophy is I want to teach you to manage it yourself, run your own money and invest for yourself. Okay, so that's that. Apple strategy again, we'd buy more. We're not, we'd continue holding, certainly not selling at the moment. And you can see the projections I've put on this, 48% in the next 12 months. So it will go up by 50% the market cap of Microsoft in the next 12 months is most probable, but we've got fail-safe mechanisms in place in case that doesn't happen, which is called the NVIDIA strategy, which I'll tell you in just 1 second. Right? Amazon, yes, you're going to get a woohoo as well. That is continuing to go that way. And that's it. It's the Apple strategy. Positive, not neutral, not negative, and strongly positive, if anything. And what do you want me to say? There's nothing more for me to say on that one at all. Now, Disney was a special situation where we thought from that, can we do what it did here before, which is do that. So Disney remains a special situation, which means higher risk. Should do this. It's not getting its own woohoo. And that's what the banks think there. So slow and steady, good educational stock because you'll learn a lot. Now, what's the NVIDIA strategy? And this has got a massive woohoo for the year because bloody hell, thanks to that, I can go retire in Bali, I think. I wasn't expecting that. I didn't know about AI at the start of the year. Or barely I did. But that's not why I bought it. I bought it because the bloody numbers were great. Now, what's the NVIDIA strategy? From the highest it's been since you bought it, if it drops X%, and X could be 10, 20, 30, right, you will sell Y%. And Y is based on your risk appetite. So solve that equation. Now, in hindsight, I can tell you what Y should be, but that's hindsight. What's the point? I can't see into the future, so I can't tell you what Y should be. All you can do is choose Y based on your risk appetite. Simple. That's the NVIDIA strategy. So, for example, if it drops 10% and you're risk averse, you might sell 50%, right? And if it drops another, and by the way, don't do anything beyond 25%, okay? So if it drops 25%, you sell the other 50%. And if you're risk loving, you might say, well, only if it drops 25% will I sell 100%. Simple as that, right? Good. Listen to that again if you need to. Analysts think that if it goes from there to there, that's the return you'll get. Well, they may be right, maybe wrong. Now, this has been a woohoo for us this year as well. Started here as a special situation. We got out here. It dropped. I think we got out once it dropped. So it dropped, and then it has been going up. That's fine. I wanted to decrease on my equity holdings because it was special situations, and this is still neutral. Meta, apply the NVIDIA strategy. If you put a gun to my head, I'd do the Apple strategy as well. In other words, I would buy it right now, but with the NVIDIA strategy of XY. If it drops X, I'd sell Y based on my risk appetite. So I still continue holding it. It's got a bit more to go. A bit worried it'll do this at some point. In other words, this and then that. That's why we do these broadcasts twice a week. So we're going to keep a very close eye on it. As Warren Buffett said, put all your eggs in one basket and watch the basket. Well, I'm watching the basket for you because every Wednesday and Friday I'm doing these broadcasts. I'm watching that basket for you. Okay, and he said, put all your eggs in one basket and watch the basket. I've just bought more of this because, again, Apple strategy, gun to my head, I'd buy more, but otherwise I'm continuing to hold. And we've had these since, I can't remember when we bought these. I think it was part of the January portfolio. So there you go. And that's very positive. That's a buy. What more do you want me to tell you? Okay, of course it could have a pullback. Of course it can do this, which is why we're watching for that kind of pattern to develop. If that develops, it's an early warning signal. And again, as Warren Buffett said, put all your eggs in one basket and watch the basket. I said that recently, you know. Keep up. Now, Cisco doesn't get a woohoo because it fell off there. If it drops below that support, we'll sell because I'm more risk neutral, risk loving. But if you're risk averse, you would have got out already. But there's nothing sort of fundamentally wrong with it. It's just, and that's a bit sort of negative. So if you're risk averse, you'd get out. If you're risk neutral, you'd wait. Right. Netflix. Now, I don't own this, but I'm showing this because it's popular amongst you kids. So that's what we're thinking. And that's what may happen. So we'll just keep an eye on it. But that's the special situation projection I placed on it. But I said I don't own it. You guys, well, if you think it's going to go up 70%, why don't you own it? I can't buy everything. Okay? I am not my wife in Harrods. I just can't buy everything. Please have a look at campaignforamillion.com. If you want to be part of the Great Investments Program or the approved filtered list, go to campaignforamillion.com or alpeshpatel.com/links, and it'll show you how to sign up to the approved list and the Great Investments Program. If you're fed up with your IFA, if you are fed up with your IFA because they've delivered you a 0% return over 2 years because they held, as Fundsmith did and Scottish Mortgage did, all those tech stocks on the way down last year, and then as they recovered this year, like a 250% in Meta, you've not seen any benefit of it because they held the 80% drop last year, then sack them. I'm going to get more forceful about this comment. Just sack them because they're bloody useless. And instead, get the data from me, join the program, and learn how to manage your own SIP and ISA. The people we've got are cash-rich, time-poor professionals like doctors, lawyers, accountants from Europe, from Australia, from Latin America and North America. And we've also got retirees, and we've got people with significant wealth. They might have sold their business for 20 million and they want to invest part of that themselves. We've got fathers and sons. We haven't actually got mothers and daughters, oddly enough. So I look forward to seeing you on the program. Thank y'all. And yeah, thanks everyone. It's been a phenomenal year. Woohoo to that. Thank you.